So we're at 55 on a annual basis using weekly RSI. Using the 10-day NDX, we are overbought with a score of 84 out of 100. So we're at the high end of normal, or at the high end of overbought. The percent stretch above the 200-day moving average is 2.42%. That makes it bullish. The slope of the 50-day moving average is also bullish at a positive 0.93. ADX is weak at 11.5, but rising, and it's based on the on recent strength. So that's a good thing. At the 84 and the 10-day NDX gets us to overbought, and ATR percentage at an astounding 1.30%, which makes it quiet. Now, what's interesting to note about 1.30%, that's still almost twice as volatile as it was during the years 2005 and 2006, when the market was grinding north in an extended and somewhat extraordinary bullish market. So it's twice as volatile as it was back then, and it feels like it's quiet right now. It's also 1/4 as volatile as it was during the peak sell-offs of 2009, and then earlier this year it was up around 3.9%. So the change in volatility feels extraordinary, and it really is extraordinary. But in a longer historical context, it's if it was like this in 2005, we'd have felt that it was volatile. The 26 ETF portfolio, you can see what that's holding, the 13 and the 26. Next reevaluation around 1 February. Time permitting, I want to cover some information about ETF replay and a difference in the way that they calculate relative strength than I do. I want to show you the differences and why I prefer mine. In ETF2, theoretical exposure is at 50%. Model portfolio is at 80%. There's no changes to the holdings, just an update to trailing stops. Next up, just taking a quick look at the 13 and the 26 ETF portfolios. And you can see that TLT has come off its winning position. It's now in second position here on the 13 and third position on the 26. Energy and U.S. real estate now at the top. Really, in the 13 ETF, you can see there's only 4 on cash, and that's going to be those globals. And basically the same thing on the 26. It's globals plus Swiss franc and agriculture are on a cash position. Looking at the health check. Let me scroll this up just a little bit. There we go. All right, so the vertical blue lines are 10, 20, and 30 days of look back. The center black line is the slope of the 30-day regression line, which looks very favorable right now. The outer black lines are the channel that are formed by the maximum excursion from that regression line. It's now, what's kind of interesting in this one is just how cyclic these moves have been. You can see we had a test of the lower channel here, a test of the upper channel here, a test of the lower channel here, and it's been going up steadily along the regression line now, and that would put a retest of the upper end of that channel would get us very close to 137, or return to the swing high from last year around March, April timeframe. So it's been that kind of a market with that sharp up, oscillating down, and now riding the rails going up. Like the green line is the 10-day moving average. You can see it has this lazy W quality to it as it climbs north through this regression channel. That's a favorable condition. Now we have price is better than the 10. 10 is better than the 50, and 10 is better than the 200. And we're getting very close now to the 50, which is this red line crossing above the shaded blue area. That's how close we are till the 50 crossing the 200. That's the old iron cross. When that happens, you can expect to see price to go up again. And my sense is that we're looking at a test of 137 next. Helped by the fact that we are bull quiet, and with ADX still down around 11.5, and with the bulls in charge, green is better than the red, has been for a while since here. All of that is very favorable to the upside. We were able to clear, as soon as we can clear this 128 resistance line, which we are testing right now, we're going to be in really good shape. On the other hand, if failure at 128 can take it back down to 122 and still be well within that regression channel. So although I am cautiously optimistic and I'm expecting the upside case here, it's always good to remember the other side of that trade. The solid red lines represent previous support levels. So here at 126-ish and 125, 121.5, and then down around 114. Those are all the previous levels of support that have held. And we just got to get through this last one here at 128, this last resistance. That's the dotted purple line. And then the next one is up around 130, 135 en route to 137. But once it gets through 128, there's really nothing holding it back. It's been so long since we had any resistance at 128. You know, we're looking at 90 days ago that this triangle that you see here pointing up, my expectation is that gets resolved in an upward fashion. Get this triangle, and I think we go up from here. You can see that we've been overbought for a considerable period of time, 10 days. The jaws of percent price oscillator opened back here 10 days ago and have been positive ever since as price has gone up. The jaws never closed. And you can see the time series here on the slope of the 30-day regression line has gotten back to favorable. You can see in places where I've highlighted the green circles, those are all state changes on swing time frames. And I like the fact that all three of them gave us early warning on a potential state change here. The Williams percent R went from oversold, started to go up. The percent price oscillator crossed over its own signal line and started going up with the jaws opening wider. And then the slope of the 30-day regression line came back to the zero line here and started going up. All of those things gave us reasons to believe all the way through this upward movement that the market was improving substantially. So I feel pretty good about the traffic lights that we have here and their ability to keep us on the correct side of the market. Moving on. Next up is the ETF Database report on the 10 top indexes. You can see we're at 50% invested, 50% cash, with the 5 U.S. indexes, or well, actually the 4 U.S. indexes plus Latin America all on a buy signal, the rest of the globals all on cash signals. So you can see that among the globals, Latin America was the first to change and get stronger. SPY is still better than the rest of the world with EFA, Inside the U.S., the strength is large caps, tech, small caps, and then mid caps. The two strongest indexes are U.S. large caps and technology. The two weakest are Asia and then the Euro-Asia blend. Next up is the world market model. Inside the U.S., you can see small cap value up in the green, mid cap growth slightly below average in the yellow. Everything else in the U.S. is above average because it's coded white. You can see treasuries, corporate bonds, and U.S. real estate above average. Oil has had a nice move up. Silver and gold still lagging, although I do like the recent price action in silver, like maybe a washout bottom, starting to get better. Mixed bag of tricks over here in Asia, less Japan. Malaysia, still the strength. Australia not doing too bad. South Korea and Hong Kong. The laggards have been India, Taiwan, China. Still very gloomy in Europe, worse than in Asia. You can see among the business sectors, energy has been on a tear with the increase in the price of oil, but otherwise it's still the defensive sectors, staples, utilities, and healthcare have been doing better. We're starting to see some strength now moving back into the industrials, and materials have gotten better. So this could be, in my view, this is part of the the emerging new year. Starting to see a little bit of economic activity now that we're out of the panic of last August. Moving on. In the 100 by 200, quite a few more symbols have gone off their short positions. They're back into kind of what I would call the neutral or cash. XLP, staples, and utilities and treasuries are still the only ones on a buy signal using these intermediate term technical indicators. But things have been getting better. You can see Latin America has come off its, oh, I'm sorry, I thought that was Latin, it's gold. Still, things are slowly improving even on a longer term basis. Next up is the ETF Top 30 from the ETF database. Still seeing it dominated by a lot of bonds, but there's some home construction here, ITB, and oil. Retail is still holding up pretty well, as is consumer staples, and those are ETF2 holdings. So still looking at the U.S. large cap conservative moneymakers are still doing the job. Well, you can also see pharmaceuticals and utilities. The defensive plays are still working. Moving on. This is a new report. I just built another parallel database for the DAF 30 industrials, and I'm running them as if they were using the same ETF2 characteristics, average, strength, consistency, and quality. I have these sorted by just the pure blended relative strength, the strength column. The top 5 here: Home Depot, Disney, Merck, McDonald's, and Travelers. No surprise when we think back to the quality report. And then on the southern end of the scale, the laggards, if you will. Alcoa, Bank of America, Hewlett-Packard. No surprises there. I've been making some tactical trades in Alcoa this past week or 10 days. It was down around 8.5 for a while and was back up to 10. Still my favorite individual stock for trading. I'm very tactical with it because, as you can see, it's still below its 4-month moving average, so I'm playing intraday swings more than anything than position trading. ETF liquidity, no real changes among the top performers. Silver continues to drop its interest. It's down now to 18th out of 30. And now that the margins have been raised on it, it's not nearly as much fun to trade. The VIX ATR percentage, the daily ATR percentage, right at 5%, so it's down from almost 9% where it was just a couple weeks ago. Part of the general decline in volatility that we've been seeing. Okay, we're going to shift over now to the daily report for Monday. We'll just start in the second row. The only thing I really want to highlight in here is that we have been overbought for a considerable period of time, and it can stay that way, as you know. No signals in the channeling or the overreaction. You can just notice how much volatility has really declined. We are deep into the quiet zone. You can see ADX is starting to hook up. It got under 10, and it's now back up to 11.5, and the bulls are definitely in charge. The nice thing on that is that says that we are very early in the game for a return to the bear, or I mean a return to the bull, excuse me. If this really is the start of a bull market, there is plenty of room for it to get trendy. We are still very early in that narrative. 10-day min pain, Home Depot, Microsoft, Caterpillar, Disney, and GE. A couple technology ETFs in there, the NASDAQ and the S&P technology. 10-day max pain, Verizon, Alcoa, Walmart, IBM, and Bank of America. Among the ETFs, it's the VIX, natural gas, Germany, South Korea, and VGK. I think it's not sure what that was. We got a 551W pattern in treasuries, channeling signal systems for utilities and XLP, which is the consumer staples. I really like that signal for those two very low risk conservative ETFs. Triple screen for Verizon, channeling on Johnson & Johnson, Coke, and IBM. I'm very interested in Coke for that reason. I've added a new segment in here, the auto framer, minimum 2-to-1 reward to risk ratio. I've also added a column here that we're about to see on the both for the ETF and for the Dow. So I'll show you how that gets read. But these are symbols that all of which have, if you were just to take a mechanical entry compared to Friday's high, and then use the 10-day high as the profit target and used Friday's low as your initial stop, all of these symbols are things that have better than 2-to-1 on a pure mechanical daily bar trade. Okay, moving on. Next up is the daily tactical summary. I've changed this report, I think, since the last time we had the webinar at the end of the last year. I've added some explanatory text boxes in here, and basically, if you've been listening for a while, you're not surprised by any of these, but just identifies what all the different signals are for these patterns up here, and then this piece here, simply talking about the this identifies the percent gains or losses over the different look-back periods. So that's what it's gained or lost for 1 day since the close 10 days ago, 6 months ago, etc., on a percentage basis. And then the color codes, green, mean that they are more than one standard deviation above the average of the Dow 30 for that time period. And red means it's more than one standard deviation less than the average of that same look-back period. So it tells you who the exceptional winners or losers are in each of those look-back time frames. So right now what you can see is, just by a quick inspection, you can see that Microsoft and Walt Disney have been exceptional winners on just about every look-back period that you might want. Alcoa has been a long-term loser and then a short-term loser, although it did have one little period of time over the last 5 days where it had a nice bounce. And then this last section in the pink here, the Tortoise NDX, this is the same thing. This computes the score on a scale of 0 to 100 for the Dow 30 for each one of those look-back periods, and it tells you, where in that scale of 0 to 100 it fits. If any of those had closed above 100 or below 0, they would flash red and green, respectively, but green if it was over 100, red if it was under 0. But they all have closed within their look-back periods. There was no breakout on Friday. So the last thing I want to talk about on this one, though, is this new column that I've added here, the Auto Framer Reward to Risk Rate, AFR.R. That's the Auto Framer Reward to Risk Ratio. And what that does is it, on the spreadsheet, I calculate for the Dow 30 and the ETF 30. I take a look at the reward to risk ratio if I just use mechanical framing on them, regardless of the pattern. It also works if there is a pattern it fires. Like, for example, Verizon fired green on a triple screen. VZ is on a triple screen. And its auto framing reward to risk ratio is 2.7. That means if I bought 5 cents above Friday's high and used 5 cents below Friday's low as my initial stop, and then calculated my profit target as the 10-day high, then the reward to risk ratio on that trade as framed is 2.7 to 1. So anything greater than 2.0 is going to be flashing green than with the reward to risk ratio. So the other one that fits this category is Walmart at 2.3. Now Walmart, you'll notice, has no other patterns that fire. It is number 4 on the max pain range compression style, and it has a 2.3. So Walmart is of a lot of interest to me, just for that reason. It's max pain range compression, which is kind of a style, and it has a 2.3 reward to risk ratio on a mechanical frame, so I like it for that reason. So that's basically the new column that I've added, and all that does is it consults another sheet in the master spreadsheet, and it computes that reward to risk ratio. So it gives you an idea of, what, because I pay so much attention to the Dow 30. I feel like I can trade things that have those kinds of favorable auto frames, even if there's not a particular pattern that fires over here, like in the case of Walmart. I feel like that's tradable for me. I'm probably going to do a write-up on that one as well. It's becoming such bread and butter for me. Okay, so basically the same thing is going to happen now for the ETF 30. I've added the similar text boxes in there to remind you what all the areas mean. So this first text box really is talking about what happens in all of these, in this section of the report I'm circling right now. It identifies the patterns, describes what max pain is, max pain range compression, and again I've added that auto framing reward to risk ratio on there. So you can see right now there's really 3 that have auto framing reward to risk ratios better than 2. That's silver, the S&P 500, which is nice. I love that because that's like a market condition right now. And then the NASDAQ 100 is at 2.1 also. So all that is really favorable. I really like silver right now because it was a big loser Friday. Even it was a big gainer over the last 5 days. I actually cashed some on there, and then it was a big loser Friday, and now it has a max pain range compression value of 4 and a reward to risk ratio of 2.1. I really like it for that reason. Okay, so moving on. In the frog quality report, you can see there's still quite a few that are above 3 on the nice mix of ETFs and Dow 30 stocks that are all above 3 on their frog quality report number. This AT&T looks really interesting to me. I mean, it's a green high frog quality number on a daily, weekly, and a monthly basis. There must be something going on in AT&T that looks really good. And then it's interesting to me, Pfizer on a monthly and Kraft on a monthly basis. And both of those have been clear winners over the last 6 months. So there's something to be said for high frog quality numbers. If you take a look at, so we got Walmart has been a winner. That's a consumer staples on a monthly basis, 2.9. A couple more down here in the green, Coca-Cola and Merck. Microsoft and McDonald's have been tech and staples winners respectively. So there's something interesting going on here with strong frog quality numbers. I think that's probably because of the gains that they've made. The average gain is high, with high gains, high average gains with reasonable volatility is going to give you a good frog quality number. So moving on. I'm going to flash right over to the market Mosaic, and we're going to take a look at a market that's been actually healing pretty well. You can see that the regression line has gotten steeper and moving up. The R squared is above 0.5, so it says, hey, that this upward movement really is a good descriptor of the kind of market we're in. We can see that it's made a 1.5 standard deviation move from the last time it crossed over. Now it's getting very close to closing the little gap because it's essentially knocked on the door 3 times at this 128 support level or resistance level. It has to get through there this week. I expect it to. And if it does, then these jaws will continue to open back up. But it's got to prove it this week. And you can see the after kind of a double or triple bottom down here on the percent stretch, we've had a series of higher lows on the percent stretch, and now we're really fighting to break out. There's an easy 8% move up to a 1 standard deviation above. That would get us back to about 138 if it makes that move and comes up and tests this last area that we saw a long while ago. That would get us to 138 to stretch that much. Excuse me. So that's what I'm using on my my profit target for longer term is market at 138. Let's see. That's all I want to cover on there. I want to get over to some typical trades. Silver. Well, this is from. These are all trades from this week. This was a Tuesday trade. So this is where we closed on December 30th. There was a big gap up, stabilized in what looked like a little triangle to me, started going back up. I bought here with my typical 30-cent initial stop loss, which was well below the low of the day, kept going. And what I want you to notice is on this particular setup, or this the technical indicators I'm using. So these are 3-minute charts. Okay, I've got 3 sets of Bollinger Bands on them. I'm using 30-period look back as opposed to the traditional 20, or sometimes you see that as 12. For me, the 30-period just makes more sense from a statistical basis. And a couple things I look for. This dotted line in the middle now that I'm coloring in with blue, that's essentially the 30-period moving average. In this case, it's 3 minutes, so that's like the 90-minute average. That to me represents the trend direction. When the market trends, you got this gap up and then it never sold off. I want you to notice how it never comes back to that dotted line in the middle. That when there's a clearly identifiable trend, you'll see that blue area in the middle, which is plus or minus 1 standard deviation, that stays clear. You can see the direction of the trend, and price stays away from it. And then what I'm looking for is this 1, 2, and 3 standard moves away from that center line. Now, this solid red line is a simple 12-period moving average. The black line is a 30-period regression line, and then there's this intermediate one. This solid blue line is a 10-period regression line. Now, what I've noticed is that when the 30-period regression line, the black line, stays above the red line, it kind of confirms that the trend is still going. So you can see during this entire period, really from the gap opening all the way up the 30-period regression line never crossed over the red line, and it was well away from that median in the middle. And so it was very easy to believe in this as a powerful trend up that whole day. Now, some things that I look for when it comes like time to add to positions. Well, first of all, I like this little thing here. I'm calling the Bollinger Band pinch. You can see how this distance from the outer band to the outer band is narrowing. Down here, the Bollinger Bands are very wide. It looks like this. It'll probably be like that. You can see just how this great distance from the edge to the edge, and this is compressing. It's pinching in, and now what you can see is you got this, what I'm calling a Bollinger Band pinch. Breakouts from the Bollinger Band pinch, like what I just circled there, become very interesting to me, because it is stabilized in an uptrend, and now you get this universal entry with some movement, and so it doesn't surprise me to see that thing still going up. Now, on counter trend rallies, when I see the trend going up, it's not unusual for it to stay in this pink area up in here. It's kind of riding the fast lane or the passing lane, I think of it as. I think of that as a 3-lane road in either direction, with this median line as the center divider. Any breakdowns from a powerful trend like this, the target to me is price is always going to come back to test the average. And when it does, it never surprises me when it hesitates right in here. And then the next move is either going to be a resumption of the trend or a breakdown to the edge, either 2 or 3 Bollinger Band moves outside of that. So if that's the case, if this thing is starting to break down, I don't mind taking exits here at the edge of the blue in order to preserve against the move back to the line here, because even if it goes here, it could go 1 more or even 2 more. And so I really get interested in preserving gains after a nice long move up, knowing that if it comes back and then starts to give me this lazy W up before it ever crosses this blue line, the dotted line, then I feel like I can buy all kinds of dips. Okay, so that's how I'm generally using. I'm looking for the slope of that center line. I'm looking to see, is price well away from that center line, or is it clustering? If it's choppy right around that dotted line, what we're going to see is that center line starts to flatten out. But until it does that, I like buying these lazy W dips all the way up because the primary trend is still in place. Let's see another one. Okay, now what I showed you was the were the exits, or were the entries on that one. And now I want to show you how the rest of that silver trade unfolded the rest of the day. So here we have that big gap up. This is where I make my entry. This is where I was describing the Bollinger Band pinch right here. In that my actual trade, I entered here, second position. And I want to show you why. At this point right here, where I make my second entry at 28.35. Just a minute, let me let the killer dog out. My neighbor's walking the dog. All right, outside, Mo. Okay, so I had made my first trade here at 28.05 with an initial stop of 0.3. It's moved up one R in my favor, and now is starting to leave the station again, and it has cleared the high of the day, and it hasn't even gotten back. It never even retraced back to the dotted line. All it did. Let's see if we can zoom in here a little better. Okay, what I want you to be able to see was, so the first entry here was above the high of the day, made a new high of the day, so we get this breakout. You can see the 30-period regression line is moving up, well away from this solid red line, which is the 12-period. So we got an uptrend. Price is staying in this fast lane. It has this little sideways gizmo right here, and now starts moving out. And that's reason I get 1 R in hand. I'm willing to take this next trade with a stop down around here. Now I get 2 positions on, and now my stop on both of those positions is here. It still keeps going up. Even after the Bollinger Band pinch, you can see where that pinch occurs. And it expands all the way through there, hesitates for two bars, and then starts taking off again. So I get another good fill in here. And now I get 3 positions on, and this rascal is going up. And it is well away from that dotted line in the middle. And now we're holding on to a pretty good trade right there. Let's see if I can get this. All right, so now we're holding 3 positions. We got an entry 1, 2, 3 bullets in. We get this move up to 28.91. It starts pulling back. My exit is right here on all 3, and the reason for that is let's zoom in a little more. Okay, so here we are. So now I've got 3 positions on. This was the 3rd entry. And when I'm up in this region here, on a nice move, I've got about 5 R in hand. across those three positions. It was like 2.5 R on the first one, 1.5 on the second one, and then 1 R on the third one. So I'm holding about 5 R in hand right here, and then it goes let's see. So it makes this high right here, and that's about 5 R, and then I get 1, 2, 3, 4. This is 12 minutes where it has failed to follow through. And now what you can see is this, the 10 period, this thick blue line is the 10 period regression line. The black line is the 30 period regression line. And I get this crossover right here. It normally takes about 3 or 4 candles of no more follow through for that to happen. And that's a concern when that happens, because it's getting weaker. And now you can see that it is moving all the way up. It was pushing the boundary of the pink and the green, and now it is pulled all the way back to the edge of the red and the green. So it is pulled back that far. Now my concern is that from here, the normal move on a retracement is back to this dotted line, which is the middle of the Bollinger Band. So I want to preserve this this profit right in here. I think that's going to be the normal move, is for it to come back all that way back to like 28.60. So I'm going to get out at 28.75, and that's a half of an R. And so on 3 positions, that actually represents 1.5 R of potential profit that I'm locking in by getting out at this red line. Now, price noodles around here for another few 4 or 5 bars, but the main point is that this long, beautiful run that let me get 5 R in hand or so started to dissipate, and it didn't really pull through, and it looked materially different to me. So that's the main reason to get out of that trade for me. And then cash, I think I ended up netting about 4 R because I ended up giving back 1 on that move. Yeah, okay, yeah, that's right. By exiting at 28.75 at this red line, I end up getting this move, and this move, and that nets out to 4 R. Plus it's getting right around noon Central Time, so now we're looking at the lunch doldrums. So this was silver's nice little move in here for me. Okay. So what I'm doing is using the let's see, Mike asked me a question here just a second. How do I decide on a 30-cent I stop? That's like half of a that frog standard deviation, and 30 cents just seems to work pretty well for me on both silver and on IWM. For IWM, the Russell Small Cap, that's like 3 points in the contract. And that's about half of a frog quality number, that daily standard deviation of range. And so for me, what I'm interested in is having a stop that is just wide enough that if I time the entry right and it starts moving in my direction, I'm going to start locking in R's pretty quickly, but wide enough so that if I can manage the exit. And so it just feels like a natural progression for me. I would start with a frog, that daily standard deviation of range, the frog number, and then manage it there. And as you start shaving off the size of your initial stop, your dollars at risk are reduced, and the amount of distance it has to go before you get to no lose and before you start adding R's gets smaller. And that's some position sizing math on there. Okay, so the next one I want to show is let's see. We'll pull one in on IWM. let's see, I think this was also this week. Yeah, so this is Leapfrog 2012-0105. So this is the 5th. This is Thursday. And so here was the opening. It was a gap down opening and sold off into what looked to me like low of the day. And so, yes, it made this bottom. This is about a 20 or 30-minute bottom that I'm putting a square on right now, this whole area. And then it made a rebound test back up. Look right here. It comes back to that Bollinger Band midpoint, fails, and now it finds a low at only -1 Bollinger Band of a move. So I want to show you sort of an intraday relative strength kind of a deal. So because of this big gap down here, although it's not really that big of a gap, you can see that you have a Bollinger Band expansion compared to the last little bit of yesterday was very tight range. So with that big gap down and the sudden directional move down, you get this very wide Bollinger Band expansion. The first move down gets right to the edge of the 3 standard deviations down. You can see it's on the edge of the green. The next one, it goes up and it comes down, and now it's at the same price level, but it only got like halfway into the pink or the 1.5 Bollinger Band move. And then this first little bounce up only got into the pink, and then on the second one up, it went all the way up through the pink to the blue and gets up to the median. And now it pulls back, and now it only gets to the edge of the blue. So you can see that even though the price improvement was only a little bit better, and you can see here how it's hugging the regression line, it didn't get relatively worse. In fact, it's getting relatively better. So this is kind of like a lazy W, not only in terms of price, but also in terms of how far into the Bollinger Bands it penetrates. So now, after this one, it comes up into this little zone. Now, right around the median point, look at all that nice cluster, very tight cluster of price that I'm blocking out right now. So while it's noodling around right around that 30-period average, look how far we're now 90 minutes into the session, and the MACD histogram went from red to green. It even had a crossover here where I've highlighted in the green circle, and at this dotted line is where that's where my interest has really peaked. The dotted line is where I'm really stalking it now, and I'll show you why. So what we have is we have now a Bollinger Band pinch. We have price getting relatively better on a price level, and then on the basis of the Bollinger Bands, it gets into this cluster right around the mean, and it fails to fail further, and now it starts to expand and go the other way. And now it has crossed the center line and is now starting to move out to the top. So let's take a little bit closer look at this. Whoa, sorry about that. Got a little crazy with the mouse wheel there. Sorry about that. Now this area where I'm highlighting right in here, there's a lot of things going on in this little area. One of them is price is starting to leave the Bollinger Band. You see in the downward trend, price was moving down and it stayed away from the dotted line until it came back. And now during this long upward move, you can see it's pulled away from this dotted line and keeps going. Well, where that happens, where that transition occurs, is right in this area, right after we've stalked it, and it failed to fail further right here. It just got to the edge of the -1 Bollinger Band and then started going up, pulled back. It held support right in here at the Bollinger Band median, and now it's starting to go up, and that's why in this green circle, at that green line, that's where I'm entering with a stop just below. That's about 3 points. And against all odds, the thing actually works. You get this immediate range expansion. You can very easily get to no lose here. So in about 10 minutes, I can move my stop up into here or even up into here, and that's going to be a 1 hour win if I just move my stop up into here. So this is my no lose limit. This was my initial stop here. So again, this the crossover of the 10 and the 30, and price crosses that dotted line. This is also from the low. This is half of a frog, frog quality number. They're that standard deviation. It's 0.5. So even if you were gonna like front run the frog move, this little price move in here is half a standard deviation. So I felt pretty good about entering right here. Now I want to expand this out a little bit more. Now on this one, I did not add into positions because I was teaching a class at this time, so I made my little entry and put my trailing stop in, and it just kind of kept working. But in each one of these blue circles, what I've labeled as opportunities, what I want you to notice is that in each case what we had was price moved up and it pulled back, but it never got to that dotted line. It just hung right at the edge of the blue and then started going up. So that makes those are the kinds of areas where when it might have failed but it didn't and it starts to go up, that looks like an opportunity. You see another one here. It came back, held sideways for a while, got to the edge of the pink, didn't fail, started to leave the station again, and then you get another nice leg up. Here, it starts decaying. It's not really losing on price, but it moves to the edge of the blue, and instead of failing back to the median, it starts to go up again. So each one of those represents a failure to fail further, in my view, and it shows that there still is some juice left in that move. On this one, what I ended up, you can see where the 10-period regression line crosses the black line, and then price decayed all the way back to the dotted line. I'd come back from my class at that point, and now price has pulled back to that median line. And now what you have is really, I look at this as one big, nice mega move up. It left the regression or the Bollinger Band midpoint here, and it rejoins it back up in here. That looks to me like one big arc, one big upward move, and by that point the move is over, so I'm ready to cash this one, and this turns out to be 3.5R. Let's see, Lisa has asked, just a second. What keeps me from thinking the high of the day will prove to be resistance at that point? Well, it either is going to be resistance, in which case if it fails, it's going to come back to the dotted line. But really, on all of these, it either is going to go up, and if it breaks through, it's going to go sharply. So I want to be in the position before it goes out. Oh, you asked me what made me think that this might not be the... Oh, okay, I see what you mean. Hold on. Okay, back on the first entry. The question was, let me zoom in here. Yeah, you're looking at, let's see. This is probably the high of the day right here. Yeah. And so I'm entering right here on this big green candle, recognizing that that might be resistance at the high of the day. Yeah, if it does, the failure was going to come back in here. And if it does that, like right after I buy it, if it goes up to here to resistance and doesn't go through, it's going to come back and test this dotted line. And if it does, I'm probably going to scratch that trade because it's only another 30 cents to here. But my bet is that what I had was it found support, found a little support at a higher level here. It's getting better on the Bollinger Band pinch. It left at price crossed over the dotted line. The dotted line is actually starting to roll over and move up. I'm willing to bet that if it gets through that resistance, the next thing it does is close this gap. And look, here's the what I'm drawing right now is if it gets through the resistance of today's high of the day, which is this line here, it's going to go this far. And then compared to my risk, which is this, that's 2 rewards to 1 risk, and I'm willing to take that trade. And in this case, it actually got up here, and in fact, when it closed the gap, it then there was some sideways price action, but still, you're already holding 2R, you're between 1 and 2R in hand while it's hesitating all the way through here, and then it never failed down to the dotted line, so that's actually still pretty favorable. Is that clear, Lise? Okay. So the final point, just a couple other comments then on this one, and then we'll call it a night. It crossed over the. Here's what I want you to see is when it closed the previous day, it was like right at the median point of the Bollinger Band, and then it was a downward price action because of the gap and the sell-off and all that. And it's not till it gets to this solid blue dot that I'm scribbling. That's kind of this one arc of a move down. And you can see how that black line, that 30-period regression line, sort of marks that out pretty well. And then once it leaves that congestion area here and starts moving up and up and up, it leaves that dotted line alone, and now you have an emerging trend. Now these pullbacks all become opportunities to buy or add to the position or enter because they are not failing back to the dotted line. But on this one, what you can see is that one actually failed through the pink and came back all the way to the median, and that's why I end up getting out right here. I think price on this one came back down to about here a little bit later that day. But my point was I already had enough reason to believe that this nice little arc of a move was over, and it was just on that initial 0.3 initial stop. That's 3.5R. Now, if I had used a dollar stop on that, then that would be simply a 1R move, which is still not bad. I mean, you don't mind taking an R move on an intraday trade. So what I really like about this one that I'm highlighting here is you can see there's a Bollinger Band pinch here. Even if you didn't get this first one, you could actually make the strong argument to enter here for the first time, because now what you had was a Bollinger Band pinch. It gapped down. You can see that it sold off. This is actually pretty close to just a frog entry off a low of about 73.60, and then this is up here around 74.50. That's about 90 cents. That's about one frog quality number, a standard deviation move up. So that was there are a number of reasons why that you don't mind taking that as an entry either. Okay. So it's a little past 8, and I got some other work to do tonight, but so it went a little bit long. But I wanted you to get a feel for some of the things that I think are working intraday. As the market is improving, I'm seeing more opportunities on the long side, and so now I'm willing to take these upward moves intraday with no overnight risk, and then using things like we've seen a couple cases. One was a gap down, morning hook, turn and go, and then the other one we saw in silver was a big gap up, and then it just kept going. So again, the direction of the gap is not as important as what the price action is telling you, and I am finding it very handy to use these Bollinger Bands of 1, 2, and 3 standard deviations using the 30-period look back, and how I wanted you to see how I am interpreting price action with respect to that. And then I'm really liking this 30-period regression line as sort of a guide. If you stand back and look at that price action a little bit in there, what you can see, the solid black line in the middle does a pretty good job of describing the main line of the trend. So whenever the regression line was on one side of the mean and then crossed over like it did right here in this little cluster, I'm really open to the possibility that that is a change in direction for the day. I don't have anything written up on that yet, but That is definitely how I am interpreting that. And then you can see I ended up getting out here, and then shortly thereafter the regression line crosses back into the, so I felt pretty good about this exit right here, and I like the fact that the regression line told me price was bad and then was getting better right in here, and now it highlights this nice move all the way up. So just some food for thought about how to maybe look at the intraday trade, looking at broad trends and just price action. So, and if you got any questions on this, I do intend to do a write-up on that. Hopefully I can get to that this week. I will certainly have it done in time for the February live trading workshop, so I can hand that out to the guys that are coming. Oh, note for Mark McDowell, Ed Pemector just said he was not able to come, so you know it's kind of short notice, but we do have room for one more. Mark, if you have anybody in mind, I think we could fit one more in there. That's if did you have Ed as on the list to come? Just send me a note on that. Okay, then we're not. I still think we could fit one more, but that won't be a problem then. Okay, well, you guys have a good rest of the evening, and stay warm and dry wherever you are, and good week of trading ahead, and we'll see you in the chat room. Cheers. Take good care, everyone.